In this video, we will look at the answers to questions such as, should you still buy Xcn coin? Can you add from here? Will the price go up from here? Watch until the end so you don't miss anything. There is a clear downtrend in Xcn coin as the price is falling. From a technical analysis perspective, when the price consistently makes lower highs and lower lows, it indicates that the market is under the control of sellers and the downtrend is continuing. This kind of downtrend usually reduces the confidence of investors and makes buyers cautious. However, if Xcn coin wants to turn bullish, it first needs to break this falling trend line to the upside. The falling trend line represents resistance levels that the price has tested multiple times but failed to break through. Unless this resistance is broken, we won't see a nice rise. There is a significant bullish order block just below where the price is now. Order blocks are generally known as areas where large institutional investors and liquidity are concentrated. A bullish order block is a level where strong buying has occurred in the past, and the price has reacted upwards. Therefore, it is likely that the price will find buyers again and react to the upside when it hits this area. Once the price reaches the bullish order block, strong buying pressure from here could be an important signal for the start of the uptrend. This can be expected to work as a strong support area, especially if the price has tested and reacted to the upside several times in this zone. You can consider this point if you want to buy or add. There is a significant bearish order block above the price level. Bearish order blocks are usually areas with large sellers and strong selling pressure. These are the areas where the price previously received strong selling reactions and moved downwards when it reached this level. Therefore, when the price moves higher, it is highly likely to face selling pressure when it reaches this level. Since the bearish order block is an area where the price has previously received a strong downside reaction, it is likely that a bullish move towards this area will again see selling pressure come into play and the price will be pulled back down. Especially when the price hits this area, the lack of an increase in volume and the inability of the price to break out to the upside indicates that strong resistance is encountered. Such zones are often considered as profit-taking levels or entry points for short positions. If the price gets a strong seller reaction when it reaches the bearish order block and a bearish pattern forms here, this indicates that the price may start its downward movement again. It is difficult to break it in one go. It should try to break it several times. And as of now, according to the Elliott wave theory, a distinct wave structure has not formed. In order to analyze Elliott waves correctly, the first and second waves must first form. The first wave usually represents the beginning of a new trend and indicates that buyers are gaining strength in the market. However, the second wave, which immediately follows the uptrend, is a partial retracement of the price and allows us to understand whether this movement is a healthy correction. At the moment, there is no clear first and second wave in the market structure, so it's not possible to identify the third wave. According to the Elliott wave principle, the third wave is usually the strongest and longest. However, in order for this wave to be realized, the first wave must first be cleared with an upward movement, and then the second wave must be completed with a healthy correction. If the price action makes a strong enough breakout for the first wave and then forms the second wave with a shallow correction, then a significant bullish scenario for the third wave can be discussed. We should wait for the first and second waves to form. There was a descending triangle pattern on the chart, which is generally considered to be a pattern indicating the continuation of a downtrend. Descending triangle patterns are characterized by descending peaks on the upper side and a horizontal support line on the lower side. The formation of this type of pattern indicates that sellers are creating selling pressure from lower and lower levels, and buyers are trying to hold the price at a certain support level. However, when the price broke the lower support level of this pattern, there was a sharp decline in accordance with the expected scenario. This is because a breakout of the descending triangle usually brings a strong wave of selling, triggering traders' stop-loss orders and accelerating the downward momentum. After such breakouts, the broken support level can often be tested as a resistance, meaning that even if the price tries to rebound after the decline, it may see selling pressure again when it reaches the previously broken area. If the price now sees the breakout as resistance, we need to break above it again if we want to see a big rise. A descending channel structure has formed on the chart, and it is considered a technical pattern indicating that the price action is bearish. The descending channel consists of two parallel trend lines, the lower band and the upper band, and the price usually moves back and forth between these two lines. Currently, the price has reached the lower band of this descending channel. The lower band of the channel usually works as a support zone, and when the price hits this level, buying pressure may increase. However, if the price fails to get enough reaction at this level and breaks the lower band, the decline can be expected to deepen further. If the price gets a strong reaction from the lower band of the channel, the price may start an upward movement again and come to the middle band of the channel, and if it can break it, it may rise to the upper band. On the Bollinger Bands, the price continues to move at the lower band level for a long time. This indicates that the selling pressure is persisting in the market and the price remains under pressure. Generally, a prolonged period near the lower band of the Bollinger Bands implies that the price is in oversold territory and a reaction rally may be possible. However, a prolonged stay in this area may also indicate weak buying pressure and a continuation of the current downtrend. If it bounces upwards from the lower band, it goes to the middle band, and if it breaks there, it goes to the upper band. The MACD indicator continues to move in a bearish trend in the lower zone at the moment. This suggests that the market is still under bearish pressure, and the momentum is moving in the negative direction. A wide distance between the MACD line and the signal line implies that the bearish momentum is strong and the price remains under downside pressure. However, if the MACD indicator starts to slow down and makes an upward crossover, this could be the first signal of a trend change. An upward intersection of the MACD in the downside zone may indicate that the momentum is starting to turn from negative to positive and buyers are starting to enter the market. And if this intersection crosses above the zero line, the upside accelerates. The RSI indicator is currently showing a clear downtrend. This suggests that the price has been moving with a weakening momentum for some time, and that selling pressure is prevailing. The RSI is an important indicator that is often used to identify oversold or overbought levels and to gauge the strength of the trend. Currently, the RSI is moving along the falling trend line, indicating that the market is still weak and buyers are not gaining enough strength. However, if the RSI breaks this falling trend line to the upside, this could signal that a change in momentum has started and buyers are starting to gain strength. And when the RSI increases after breaking the trend and retesting, the price will increase along with the RSI. The vortex indicator is an indicator used to determine whether the market is pressing in a bullish or bearish direction. Vortex consists of two lines, blue and red lines. The blue line represents bullishness, while the red line represents bearishness. The positioning of these lines relative to each other gives important signals about the direction of the market. Currently, the red line is on top, indicating that bearish pressure is dominating the market. This means that sellers are stronger in the market, and the price may continue to move downwards. The predominance of the red line signals a continuation of the bear market in general, and a downward trend in prices, but if the blue line can move to the upper side, then the uptrend begins. And when we look at the 200 EMA, it is an important indicator used to determine the direction of the long-term trend. If the price breaks above the 200 EMA, it is usually considered a sign that a long-term uptrend has begun and the bull market is strengthening. The 200 EMA is a critical level in understanding the overall direction of the market, and when the price crosses it, it indicates that more buyers in particular have become active in the market and the uptrend will continue. However, in the current situation, although the price has tried to break above the 200 EMA, it has not been successful in crossing this level. This suggests that sellers are still active in the market, and the 200 EMA is working as a strong resistance level. If the price can climb and hold this level, it would be a strong signal that the uptrend will be sustainable. Breaking above the 200 EMA could signal that the price has the potential to make new highs and signal the market's return to the bull trend. The price has been below the 200 EMA for a long time, so it is constantly falling. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon!